A lot of questions from the investors. Are the recent comments from China about increased regulatory scrutiny from their end, is it making it more difficult to set up global indices? Some are arguing China should be considered a sort of separate asset class from the U.S. and the rest of the world. Is this really an issue? Dan, are we going to see indices that are the world ex-China? And I mean, maybe you're neutral on all of that, but talk to us a little bit about that.
Yeah, look, at a high level, I mean, what we want to do is make sure, again, we're basically reflecting kind of the playing field, if you will. Once policymakers and regulators around the world kind of set those guidelines, our job is to go in and then once the guidelines are set, is go into those addressable markets and being able to build benchmarks and indices that really reflect the investable markets there. So we continue, to do that and really kind of engaging really with our clients where there's demand. We can build on the standard benchmarks, but we have sophisticated clients that may want custom indices. So it's really kind of the engagement, based on kind of client demand where we want to move forward.
So Tom, what Dan is saying is they're sort of neutral on this. They build indexes. You want an index one way, we'll build it this way. We're not ideological on this issue. But I'm wondering how you feel about this, because for 20 years, you and I have been talking about growing the global portfolio, making it easier to invest, believing largely in passive indexes, but also to a certain extent on some active management. And we all should have an allocation globally. It's gotten easier because of ETFs and because of indexing to do that. We've all thought, okay, so all world, ex-US, China should be 5% by market cap. So we should have indexes with 5%. If you want emerging markets, China might be 40%. I'm wondering if, given what's going on with China, what you're telling your clients, is China, first off, still investable, number one? Number two, if it is there much greater regulatory risk? And number three, is the idea of just investing by market capitalization perhaps not such a good idea, or does it not matter?
Well, so Bob, we had Brendan Ahern on last week talking about China. You know those folks over at Crane Shares, they do a great job. He pointed out that every year or so, there's a lot of saber rattling going on between the U.S. and China. There's no way that we're going to separate the capital markets of China and the U.S. They're too intertwined at this point. But everybody's in a competitive spirit. There's a lot of innovation involved. And that's really key and critical. So it is going to be all about choice. If you've got a problem with China, there's some great indexes out there that are ex-China. But China is the second largest power in the world, and they're going to continue to innovate. It was very, very telling when we did see the dip in the Chinese stock market because of the recent tension. $2 to $3 billion came into KWEB, that China Internet ETF. I think a lot of people are buying on the dip for all the right reasons.
Well, it's a value trade. Like my value friends always point out to me, China's a value play. So it trades at, I don't know what they trade at, emerging markets 15 times forward earnings. The U.S. is 20 times forward earnings. So all my value friends, you buy these stuff when it's down because it's a value play. But to me, that's like almost not quite a technical play. There's fundamentals involved in it, but it's very different than saying, okay, China's 5% or 10% of
global
market cap, and we ought to hold it on that level. It's just an interesting debate to have right now.
Sure.
I think it's very clear.
And China wants U.S. investors. They may be competitive. They may, fight back and forth with words. But again, the amount of money we bring to China companies is huge for their overall economy.